Crypto Kids, the topic of today's discussion is whether if Bitcoin's current short-term rally back over $90,000 is something that's going to be sustained or is it a fake out? And to discuss this topic in great amounts of detail, I'm very lucky to host Jamie Coutts, the chief analyst at Real Vision, once more over here on this channel. I'm very, very happy. And I'm so happy particularly that today you are working on a report over on Real Vision. So we're going to get a couple of insights from your outlook of the report that you were writing about. But Jamie, I'm very glad to have you on. How are you doing? Happy New Year.
Yeah, Happy New Year, Effie. It's great to see you again. I think we were talking just before the entire meltdown
Yeah.
in Q4 of last year, so it's a good time to revisit the discussion.
Well, guys, if you want to check out the full report that Jamie has written, then you can obviously check out Real Vision. I'll leave a link in the description down below. His work is going to be available for the RV Pro members. So I'm going to put the link for RV Pro. You can check it out. It's not just Jamie's awesome analysis that will be available. Raul himself, Julian, and I'm sure that there's other analysts too that are sharing their updates on the market. So check it out. I'll leave a link in the description down below. But without further ado, Jamie, why don't you take the screen away? I'll share your screen. And why don't you give us a breakdown on if this pump is going to be sustained or are we entering into a bear market?
Yeah, sure. So, I just finished a presentation for the RV platform this morning, so I have these slides sort of ready to go. I might switch between a slide deck and also some applications and an analytics website that I've built as well, depending on time. But I'm also writing a report as well, so I can speak to what I'm sort of seeing or what I'm going to add into that report as well. I guess to frame things first, before we sort of talk about the outlook, let's just do a post-mortem of really what happened or has happened in the last couple of years. So I, including many other people, expected 2025 to be a much better year. We had all the necessary tailwinds, and at least at the sort of second quarter onwards, we started to see the liquidity cycle start to move in a more favorable fashion. And risk assets responded to that. By though Q3, the liquidity situation started to inflect, and we had a couple of surprises, especially regarding the government shutdown. And that also culminated in the, I guess, fed into what happened in the deleveraging event in October on Binance, which was a complete breakdown of crypto's market structure and another red flag and I guess prompt for regulators and legislators to get their act together and get something passed in terms of the Clarity Act, because there's still some major problems inside the market mechanics at the moment with crypto. There's probably some very large losses being carried or some large books being unwound. Nothing confirmed. We don't know, but it certainly involves market makers and Binance. Let's say that. Um, Now, where does that sort of leave us? Well, before we get onto that, let's just think about what the market has been telling us over the last couple of years for those that have sort of been paying attention. This is a chart that you can see at the moment, which is looking at something. It's a breadth indicator which I've created. I've created crypto index and sector indices as well as breadth indicators. And this blue line is the advanced decline line. It's a simple breadth measure which looks at the number of assets within the top 200 that are up each day. And you add them together and you get this sort of cumulative line of whether the market is participating in either the up cycle or the down cycle. And you can see that since 2022, when the market bottomed, and this is a top 200 index that you can see on screen, so it's heavily skewed towards Bitcoin, ETH, BNB, the large cap assets. That in 2022, obviously, we started this new bull cycle, but the blue line continued to go down and to the right. And that tells you that less and less participation from the broader asset mix is taking place. And that is a very negative breadth signal. So what does that really mean in layman's terms? Large caps have been outperforming, but even just to be in large caps hasn't been enough to sort of outperform Bitcoin. Very few have actually done that. Last year, BNB Tron were the two large caps that outperformed. Zcash was obviously the standout performer, but it was a pretty bleak year. In fact, I ran a screen earlier today using my analytics website. 8 assets out of 80 that were above 300 million in terms of market cap finished the year positive, so 10%. So that
10%.
was the breadth was atrocious. In fact, the breadth is very similar to what we've seen in the cycle bear markets, the bear markets we've seen previously in 2018 and 19. So this is telling you something, that the structural bid for the sort of out the spectrum, out the risk curve assets in this space has completely evaporated. If you want to operate in that area, you have to be an extremely good trader, or you have to be an insider. Because if you're thinking about holding these things for the long term, there just isn't a bid. It is network adoption that is going to drive these assets higher, and you've got to see the underlying fundamentals to understand whether there is anyone using or adopting the protocol or the network. The next chart is, or the next slide, I should say.
Well, Jamie, I've one question, if that's okay. So do you think once we see, I mean, we're going to get QE this year, fingers crossed, right? We saw the end of QT.
Well, it's already started under the banner of RMP.
Mm-hmm. Okay.
So Reserves Management something program, whatever new acronym that's it is the purchasing of government bills. That is QE, but they're calling it something else because the optics are bad. And they've done more than what they said they were going to do when they announced the pivot in December. It's not enough to make a meaningful difference to asset prices. And well, what I should say is it is making a meaningful difference. It's a meaningful pivot. But in terms of how large the debt is and how much the debt has grown, liquidity has to start to really accelerate. Otherwise, we'll start to see more spot fires start to break out, like we saw in the repo market, the financial plumbing in Q4, which is arguably still happening right now, and in other areas as well.
Okay, makes a lot of sense. So we have to see then something massive for the impact on altcoins and the crypto market to be meaningful. And do you think there's a probability? This will be my last question. Do you think that there's a probability that we do see something meaningful, and by the end of the year we see that transfer of new liquidity into the crypto market, and we get at least something to fulfill the expectations of everybody that wants an altcoin season?
Yeah, so I mean, I definitely think the inflection for global liquidity is already started. So the fact, the Fed has pivoted, they're now buying. They went from QT, so letting the balance sheet contract, to now expanding the balance sheet again. Arguably not fast enough, but it's faster than what they were prescribing or saying that they were going to do back in December. It's only been 1 month.
Mm-hmm. Makes sense.
There's changes to the bank regulations, which is going to basically allow the Treasury to just issue more and more debt and have the banks absorb it. The banks will then be able to, because of the lower constraints on their balance sheets through these changes, will be able to create more loans, and that will increase credit, and that will increase business activity, which is, as you know, the business cycle analysis that Raoul and Julian do on RV is incredibly important for risk asset prices, especially, higher or out the risk curve assets like altcoins. I would still, argue that you need to be very careful with altcoins. So an altcoin season in the traditional sense, i.e. 2020, 2021, was any shit just went up, right? They, stuff that didn't have product market fit, but it had plenty of promise, just went up. And that was because there was excess supply of money, of units of currency in the system because of what they did after COVID, that it just flowed into anything. There was no discernment. And, we're still struggling with that last cycle in terms of framing what should happen going forward, because there is the anchoring bias to what was done last time to what should happen in the future. I've been arguing for a while, and it hasn't really helped in terms of 2025 performance. The quality alts that I would argue are quality, like Ethereum, still had a pretty ordinary year. It was down about 20%. But, if you've got a long enough time frame, you can look through this. look at the inflection in terms of adoption and liquidity and see that this is actually on a longer term basis, I think a very, very good entry point. But alt season, as it's previously been defined, is never coming back. There'll be periods where the entire market will go up, but like, why do you want to own something that doesn't have any fundamental value? Meme coins you can
100%.
probably park in a separate area because that's gambling, and there's lots of that as a theme is going to continue. It's a play on on the culture of the time. Memes are real; they are investable. I don't do it. I've had one little flutter, but that's it. And but I don't own it
Was
as
it a
an asset
profitable
class.
venture, or was it?
No, so full disclosure, I was going into Q4 thinking the Fed is going to pivot, liquidity is going to inflect. I added Doge, and I sold
Mhm.
it within about 3 weeks
Okay.
because
Doge
the
doesn't count.
technicals.
It's not a Melania. It's not a Trump coin. It's okay. It's a good investable
Boomer,
asset.
it's a boomer meme coin, and guess what? I'm a boomer, so that's as far out on the risk curve that I went. Um, but look, I mean, good luck if you want to play in that space. That's not my space, but the capital that's coming in is showing discernment because it's institutional capital.
Mhm.
And so you want to align your portfolios to the flows. And that means that you've, likely got to be in, you know, I mean, look, in tech stocks, you can have lots of speculative tech stocks, but like if the software isn't growing its sales or revenue, then, why would you own it? There's no difference to crypto.
Makes perfect sense. And I'm so sorry for being so rude and interrupting with a question on liquidity. I completely sidetracked you from your analysis. So I'll shift back to your screen as you guide us through the
I know,
historical annual
I
performance.
don't want to. I don't want this to be a presentation, even though it looks like one, because I just did one this morning. So the more interaction,
No,
the
I'm
better.
I'm 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 so happy. Like I caught you on the perfect day. So I'm just gonna shut up and let you talk.
Okay, well, look. I mean, the interesting thing about looking at what the year of 2025 is that it ranks on par with the 18 and 22 bear markets. Now, maybe that's not something that people are aware of because, like, hey, we're still in a bull market, right? But the entire year, if you look at it from returns, you look at the breadth of the selling. In 2018 and 2022, it's more than 75. Sorry, more than 83% of the smart contract platforms were down 75% or more. In 2022, 71% were down more than 75% or more. So that's brutal. In 2025, 50%, so half, were down more than 75%. So that, if it walks like a duck and quacks like a duck, it's a duck. I mean, it's that we had a bear market. The bigger question here is, was it the cycle low? Did
Hmm.
we see the cycle low? And I'm starting to see the signs that we've got liquidity improving, the technicals improving as well, at least on Bitcoin and some of the larger caps that are making me actually quite bullish right now. But again, I think discernment is needed and risk management is needed because the selling that we saw just recently in all assets within crypto, provided a very definable risk management level.
So
So,
do you think even though Bitcoin went from 15.5 to 126, when we is the classification of 2025 and before that being a bear market strictly looking at altcoins, or do you like to incorporate Bitcoin into the thesis and say, hey, even Bitcoin was in a bear market because the returns we will see in the future will be uncomparable?
well, yeah, this is the conflict. So it was definitely a bear market in altcoins. The smart contract platform sector was down 67.7%. Sorry, 66.2%, and DeFi is down 67.7%. Now, in equities, 20% to bear market. We have three times the volatility in crypto, so it's effectively a bear market, a structural bear market. It wasn't in Bitcoin um, because Bitcoin is obviously further in on the risk curve, and a 30% pullback in Bitcoin is perfectly normal. It does it a couple of times every year in every bull market. Now, the volatility is compressed, so a 30% decline now is not the same as a 30% decline in 2017 when the volatility was 2x higher. So you could argue it was a structural cycle bear market in Bitcoin as well. But the point being is that a lot of damage has been done to the altcoin sector more so than Bitcoin.
Makes sense. Makes perfect sense.
So maybe we can switch over to what I'm sort of seeing on the liquidity fronts, which is giving me some pause or
A little bit of hope here.
cause for like being a little bit more bullish. So this is total global liquidity. Everyone has their own metric. I use TradingView to calculate this, or Bloomberg. It just looks at the balance sheets of the central banks. It looks at global M2, looks at FX reserves, and it looks at US net liquidity, which incorporates reverse repos, which are now essentially non-existent, and also the Treasury general account, which is a big swing factor now because most of the expansion on the liquidity side is coming through the Treasury. So this has been a very mild bull market in global liquidity. We had a very long and deep contraction in 2022, 2023, and we came out of it. But so far, we've only seen a sort of gradual increase higher, and that has been constraining on the performance of risk assets, high that are out the risk curve, which is obviously crypto. The other factor, the confounding factor, has been AI has emerged as the most dominant tech theme. It trumps blockchain in terms of its significance, its meaning, the capital investment. And because crypto has, even still today, failed to achieve mainstream adoption, although we know it's coming, it's been very easy for investors to cycle out of crypto and go into AI tech stocks, right? And play that theme. The lack of real institutional capital outside the ETFs has meant that also without the Clarity Act, has that meant that we just haven't seen as much new capital come in, although, record-breaking ETF flows, and that certainly helps. And imagine if that hadn't happened for Bitcoin and Ethereum in the last 12 months. So there's a competing technology out there, which, is, I think, more important, but it actually intersects and reinforces blockchain. So blockchain will have its time in the sun again as the adoption comes through, because agents are going to drive most of the activity on blockchains going forward. But the agentic economy is still, it hasn't started, or it's in its infancy that it has no impact right now. But anyone who's investing for the future will start looking at blockchain, knowing that they need to look at the knock-on effects of just LLMs on the rest of the economy, and the fact that the administration is wanting or pushing the financial industry, to move on chain is just another reason why this secular technological adoption of blockchain is not going to slow down; it's going to accelerate.
For me, what was so frustrating, Jamie, was, again, sorry for cutting you, but I really was so upset that we were following the M2 money supply. There was like a period in time where between, I think it was, essentially from the large consolidation of 2024, March, November, into the April 2025 time, and even beyond, when Bitcoin made initial new all-time highs in summer, we were correlated with the M2 money supply with that 90 and 80-day delay beautifully. But then we broke off as commodities started to see their increase. I think instead of capital entering into Bitcoin in the crypto market, it just diverged into commodities and precious metals. So I think what you're saying now is super, super important, because you're also saying, hold on, it's not just commodities, but we have the entire AI sector, which is more relevant as an industry to blockchain as of today. So an increase in the global liquidity doesn't directly mean an increase in crypto, because liquidity has so many different avenues to go into. Is that right, what I'm saying?
Yeah, I mean, liquidity can flow. It so the transmission mechanism for liquidity is important. The alternatives at the time when liquidity is abundant, in terms of the avenues it can flow, is obviously important. We didn't have AI back in 2020, 2021. The liquidity transmission mechanism was firstly, via the banking system, which just always boosts asset prices, and it was direct to consumer liquidity as well, in the form of checks, which meant that it went straight into markets. This time around, what the Treasury is trying to do by expanding their expanding public debt aggressively is that they're trying to pump prime the economy. And when that money is spent, yes, it goes into the pockets of individuals that are working in government departments, but it's also going into capital spend, right? To invest into meaningful business enterprises. We've had a massive problem for 20 years, well, since QE really, since 2008, that QE is basically funded, has not driven economic growth because it is essentially money for financial institutions who just buy assets. Trump's trying to re-engineer the economy by, essentially printing money to engineer economic growth and drive capital investment, which has been non-existent more or less in America because they've basically offshored industry and they've allowed the central bank far too much control. That's not necessarily the same kind of money printing which boosts asset prices. It's going to be a lot more selective. But thankfully for blockchain is that you do have the actual push to adopt the technology, and the fact that these are network adoption technologies, meaning that you can see that as more users and more money flows through these networks, that it's just going to boost the value of the price of these networks. So you have to look at the transmission mechanisms, but also, if I recall back to our conversation last time, Effie, I
Hmm.
think this actually came up when you brought up the correlated chart between global M2 and Bitcoin. And
Yes.
I think at the time I was saying, be very careful with correlations because markets are non stationary, and be careful with lags because there are times where a lag will fit and then it will break down. It doesn't mean the correlation or the relationship of one thing to another is broken completely. It just means that the volatility of that relationship has changed, right? So
Hmm.
global M2 is one part of total global liquidity. It doesn't include things like the central bank balance sheets. It doesn't include the impact of the volatility of the bond market. And so, that was basically happening in Q3, Q4. If
Yeah.
if that was our time of
Yeah.
our last call, now suddenly central banks are now expanding, right? So total global liquidity is inflecting more. So the rate of change of it is changing. That's not captured in global M2. So the issue was, I think, too narrow definition of what liquidity is.
Hmm.
Also, trying to fit one time series onto another in too narrow a time frame, and trying to we're expecting it to always match. And financial markets will never do that for long. It will
Hmm.
change. But does one thing affect the other? In the report I published just recently for RV, I look at these relationships actually, and we can go to it as one of the.
Hmm.
I think it's a great way to sort of demonstrate what I'm talking about. So here is, it gets a bit technical with the statistics, but um, this is a analysis of total global liquidity, which currently sits on my definition of about 141 trillion, and Bitcoin price and the price of the Nasdaq, the index, and the sensitivity is this column here, BTCB. This B means beta or sensitivity. Now, you can see that during different look back periods, the sensitivity has changed, meaning a 1% change in total global liquidity has meant more or less of a response from Bitcoin. And then in the next column, R squared, it's how much does total global liquidity explain the weekly changes in the Bitcoin price. Going back to 2013, it's like 91%. It's one of the highest relationships I've ever seen. But look how it's changed over the years. It's going down,
This is
right?
gold. This is incredible analysis. Oh my God.
Yeah, it it verifies something that, in financial markets you always have to use a sort of like a golden rule, which is they're non-stationary. They're relationships. There are relationships which are strong and from a first principles basis sound, but the impact that they have changes over time. So I'm not saying that, global liquidity will go up and Bitcoin will just not respond to that. I'm just saying that, it's not a perfect one for one. In the case of Nasdaq, it responds less to global liquidity, but actually, weirdly, in the last 2 years, it's gone up in terms of the explanatory factor, which is this column here, the
Hmm.
QQQ R squared column. That's counter to Bitcoin. Now, that's a 2 year period in an asset class of decades.
It's
So
nothing.
it doesn't mean too much other than just to prove a point that I guess the argument is, does global liquidity impact asset prices? 100%.
Mhm.
Does it stay the same? No. But if you're investing on the short term, I wouldn't use it entirely. If you're investing on the long term, you could pretty much use it as the main thesis for why you're investing,
Mhm.
provided there's adoption of the technology as well.
Okay, wow. I had no idea that the correlation was reducing. At least, when we go into the macro, like you beautifully put, right? Liquidity is the main driver of assets in the long term, and I think yes, we know that liquidity will continue to increase in the very long term, and that should, because blockchain is technology that will gain that adoption, then our industry should also flourish. But this was wow. I'm blown away.
So, I mean, if you marry that with the assets that are getting adopted, that are growing, the number of users, the settlement volumes, the applications, then you should be okay, because I don't think these things trade necessarily on like PEs. They trade on sort of this network adoption. So more users, more volume, the more diversity of applications. It just means that the asset is going to be stored, used, and valued. So that's kind of like the underlying valuation case then for the asset itself,
Now, Jamie,
which is non-traditional.
I don't want to hold you on for any longer, and I know that we wanted to cover one part in your software that you're building, which unfortunately is not available to the public as of now. But I think it would be a very good segue and end to our incredible interview. So when we look into the projects that are actually growing in TVL, like you said, that are growing through network adoption, in an environment where we're seeing a less and less correlation, immediate correlation with liquidity, which of the current crypto assets, which layer ones are seeing meaningful growth in their networks to give us increased security for long-term exposure in specific altcoins that we may choose to invest in?
So thanks for bringing it up. I'll try and do a quick screen on this, but it always deserves a little bit more analysis than what I'm going to be able to do for it right now. But let's have a
Mhm.
look at smart contract platforms that have grown their TVL. Well, let's rank them by changes in their TVL over the
Mhm.
last 3 months, which is pretty much the period in which we've seen the worst of the bear market of 2025. It was really in Q4 where the worst of the damage was done. If we look at fees now, you're not going to see many in terms of chain fees. And maybe let's just do this on a 365. Let's have a look at over the course of the year how these layer ones did in terms of
I mean,
some of the key.
I know that Solana is doing very well, but one of my concerns is, like, I was watching a lot of the stuff from the Solana Breakpoint conference, and Solana is seeing very good growth, but about 85 to 90% of Solana's total ecosystem value comes from DeFi products. So I'm just concerned that layer ones will only serve purpose and value because of the existence of DeFi. Um, but do you see that to be a problem, or is that okay actually?
So I used to, well, it is a problem in a sense that diversity of activity on blockchains can only strengthen the technology or strengthen the value of the technology or the assets, right? So it is a problem. The where blockchain has the best product market fit though is in finance. It's
Hmm.
in DeFi type activity. So it makes sense that that is the dominant use case today.
Makes sense.
So I don't necessarily think right now that it's bad just because if yours growing in DeFi, yeah, the correlation with the price of the underlying L1 token is very strong. So it's going to do well. But the problem is that that kind of activity that we currently have, DeFi activity, is super speculative. What we need is payment activity flowing over blockchains, right? Visa, MasterCard sort of rails of the digital economy so that we get less cyclicality in the activity. The L1 token price goes straight up with fees. Fees are being driven by speculative activity, then it's very boom bust, boom bust. Hence, we get these boom bust cycles in the L1 tokens as well. That needs to change longer term.
Hmm.
Now, over time, each cycle, it's more fees. Like the bear market always sort of is at a higher level, right? But it is incredible, the durability and the ability for people to weather the volatility declines with every cycle. And so, therefore, I personally also want to see that the stablecoin payment transactions and the use cases come from that. That's a little stickier, that's more stickier, and less speculative driven, less cyclical, will be ultimately better for price.
Makes sense. Makes perfect sense.
So if we look at if we screen for all of these L1 tokens, and I haven't filtered out super small tokens here, so I'll probably get some things that are totally irrelevant that have had TVL of one go to TVL of $3, and that's a 200% increase. But let's just take a look. So on a TVL basis, from a year ago, case in point here, Flare Network, which I think is associated with Ripple. I'm interviewing, someone from the Ripple side tomorrow on the RV platform for the pro community. So I'm going to be interested to see what's actually happening there. But, case point is that TVL for Hyperliquid was up 238%,
Wow.
right? VeChain, which is sort of probably not much at all, was up 100%.
Hmm.
Sonic was up 57%, blah, 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 blah. So I could actually add more detail here to look at sort of, the actual minimum market cap or the minimum amount of TVL. So
Hmm.
why don't we do that actually before we TVL raw value display only. And let's say
Like maybe
TVL greater
5 billion,
than
maybe.
5 billion.
Yeah.
Okay. Okay. That will definitely
That will filter out the stupid ones.
like 50.
50.
Okay.
There we go.
So on that basis,
Ethereum.
which are the serious L1s?
Hmm. Hyperliquid.
Hyperliquid, Polygon, Binance Chain. Now, Binance Chain, in terms of its total TVL, to see an 18% increase in the year,
Huge.
where the market was down 67%, is very impressive. And even Ethereum to be up 3% on TVL of like 100 billion, I think is a very strong effort. And that's why Ethereum deserves its place in the portfolios on a longer term basis. In terms of chain fees, you can see that Polygon had a really good year, and that's on the back of Polymarket. I would argue, a breakout story. So that's a good example of a breakout story, one of very few that we had this year. Let's have a look at chain app count. This is a really
I'm
important metric.
surprised that even, I mean, we had meme coins over the 365 days, but Solana is still down. That to me is a bit interesting.
Well, it's also, if you think about the year of 2025, Solana in Q4 of 2024 went ballistic on the
Yeah.
back of meme coins.
Yeah. Yeah.
So it had this very high watermark, which meant it couldn't, its numbers looked terrible this year.
Mm.
It is a problem that so much of the activity was being driven by meme coins. How many more cycles of meme coin, sorry, of meme coin rinsing will it take to there's no one left? Probably never, because there's always going to be people who want to trade that stuff.
Yes.
But they need to diversify, and I think they're doing a good job. It just hasn't come through yet. They've got deep in. They're definitely moving on the stablecoin front, so I'm not concerned about Solana at the moment. But interestingly, if you look at, okay, are we seeing signs of people building, of like applications building? Sui did pretty well, but it's a small chain, and it's just starting from a low base. So these numbers need to be sort of tapered with the size of the network. But 200% is not bad. Pretty bad year. But Ethereum 22% more applications on the largest chain is amazing.
Amazing.
In a year where not a lot happened on the price front. If you look at stablecoin market cap, this is really a real important sign going forward, because this is the metric which I think will become the countervailing force to all the speculation. Is more traditional payments on using stablecoins on blockchain rails. Solana did really well, up 172%. Binance, amazing, up 115%. Polygon, again, on the back of Polymarket, 74%. So they're all moving in the right direction. So amidst the carnage, the signs that blockchain adoption is increasing in a manner which should keep itself sustained over a long time is there.
Well, Jamie, thank you so much for awesome insights. I'm super happy to have you on as always, and I'm just completely like mind blown about your platform, because it's so useful. It's I think it's something that everybody should at one point and one day hopefully have. But it is for your eyes only as of today. But we are very grateful to have an introduction of some of the things that your platform can do. But Jamie, thank you so much, guys. If you want more of Jamie's insights, again, he's going to be publishing this report over on RV Pro, which you can check out using the link in the description down below. It is a little bit pricey, but I think it's definitely worth it if you're here for the long term. And if you're investing and allocating large amounts of money, I think it's definitely one to be checking out. If you don't want to go for the Pro option, then RV Alpha I found to be very sufficient as well. So check out the RV platform. It's one of the ones that I use alongside Ben Cowan's Into the Cryptoverse and TradingView. There isn't so many tools that you need, but if you can choose the ones that are good and maybe sometimes pricey, it can go a long way. So Jamie, thank you so much for coming on. It's been a pleasure, and hope to see you again very soon.
Cheers, Evie. Always enjoy it. Have a good one.
Bye-bye.